Hey, Karan, welcome back to the podcast.
Hey, good to be here.
It's great to have you back. You and I obviously get to talk on a more frequent basis in our work here at Moore and with our clients, but it's been a while since we've had you on to talk about the global small cap portfolio and the broader investment universe that you're looking at. And there's been a lot happening around the globe, so I thought we would start there. As I said, you oversee a broad geographical area of the market. What have you seen over the last 6 to 12 months when you're looking at companies and the portfolio across all these different markets?
Yeah, so in the global small cap strategy, we have over 10,000 potential securities out in the investable universe, and we have investments that span many different geographies within that. And one of the themes, I guess, that's not anything new, I'm sure, for the listeners or for you, is just the outperformance in the US. So the economy over there has been exceptionally strong, and as a result, the currency has been also very strong and favorable. So the US has been an outperformer for some time now. And then other parts where we've been seeing some opportunity has been Brazil and parts of Latin America. More companies are coming up on the screens over there, and generally speaking, strong economies, good companies, well run. It's just a matter of finding the right valuation after adjusting for currency. And in Europe, more generally, also nothing new, more sluggish on the fundamental side. The industrial end markets not rebounding as strongly as the US has been. So Europe, just more generally slower growth across the board. And then finally, Japan, seeing inflation. So we'd been observing this for just over 2 years now, but inflation was very difficult to come through initially, but both consumers and companies' mindsets around price increases have been changing. So after years of even deflation and just a complete cultural aversion to raising prices, we've started to see that in even the consumer-facing companies that we own over there. Time will tell if that's more of a structural change or just temporary. But that's been an interesting development as well. So that's sort of what we see at a broad level. But again, I think the important part to remember is we invest in companies and not necessarily geographies. And there are many instances of companies, for example, that may be in one geography but sell globally or to other markets. And really half of the job is making sure that we pick the right CEOs and managers who will also find opportunities in the right asset classes and geographies around the world.
And maybe just to that point, and more specifically to the current holdings in the portfolio, where are you seeing both strengths and weaknesses relative to the broader investment universe?
Yeah, so on the strength side, we've owned a lot of US companies that have been doing well. So we own, for example, PEOs, which essentially are outsourcing companies that help smaller businesses with staffing as well as payroll and health insurance. So it's almost like an outsourced HR department. As you can imagine, they've been doing quite well on the back of strong employment and strong numbers in the US. So that would be an example that's done well. And then on the European side, we tend to own more resilient, boring stocks. So we own a couple of healthcare companies in both the UK as well as in Germany that sell generic pharmaceuticals, often over the counter as well, branded items. And those chug along regardless of sort of the end market or economy, because people still need to take care of their health, and they provide affordable options for that. So those would be some examples of both companies that are doing really strong because they're buoyed by the economy, as well as companies that are just chugging along regardless of what the economy does. Maybe not the fastest growers, but also not hit on the negative side, even if macro is a bit weaker.
One inescapable theme right now is AI. It's seemingly everything, everywhere, all at once. More specifically, we're talking about generative AI and all of the excitement around it. And I'm not discounting the potential that it may have in a more direct or acute way, but I'm more curious about the second order impacts. For example, there's talk about how the power supply might need upgrading to meet increased demands from data centers supporting those AI models. Another area I wanted to get your thoughts on was the replacement cycle of hardware and software for businesses around the world that will presumably need to be upgraded to integrate the widespread use of AI going forward. And in the global small cap portfolio, some of our key long-term holdings fit into the category of either a value-added resellers or IT solutions providers And these are sort of a combination of distributors with this consultancy service that's layered on top of it for these businesses that are constantly trying to stay on top of their technology needs. How do you see the integration of AI in this sense? So, and the potential impacts it may have on business models like those that I just mentioned?
Yeah, so I think you're right. The first order effects from generative AI would be the most obvious hardware related items. So this would be GPUs or graphic processing units that NVIDIA sells, data centers, things like that are tip of the spear. But as you sort of move on, those things will eventually get integrated into software. So obviously, OpenAI is the most obvious example of software. But I think one category that we tend to focus a lot more on that fits somewhere in between there is services. These are things where they're helping and advising their clients make solutions. And those solutions may have a component of hardware in them, or they may have software or a combination of the two. So I think that's really where we've been focused on the service side. As you alluded to, the two main business models that we've invested in the strategy are value-added resellers and then IT consultants. And the nuance over there, so value-added resellers is they would help often small, medium enterprises or public clients, for example, with their IT solutions. So even at more, if we want to buy or upgrade our hardware, and that could be laptops, servers, things like that, or if we want to add licenses, including Microsoft licenses or Google, etc., we would not do it necessarily all in-house. We would work with an external partner that can both advise us on what sort of solution to provide, and we would purchase it through them. So they act almost as a service provider / distributor. And that's one example where AI, for example, could affect them. And then IT consultants, again, the more obvious example too. So the first piece I think to talk about is just that replacement cycle. So yes, through COVID, a lot of the hardware side of the business was pulled forward and people upgraded their laptops and microphones and headsets that we're using here for the podcast. So that was a big boon in disguise for companies like value-added resellers. But that's sort of been tailing off, and we're back to more of a normal level now. And have been for maybe the past year or so. But what we're starting to see is actually a transition in that distribution business model over time to providing more software. So a lot of software, actually, including cloud services, are purchased through these partners who act as an outsourced sales force for big companies like Microsoft, who has no patience to go to hundreds and thousands of small businesses like ours to sell to them. So they're acting more as software resellers increasingly, and also as solution providers. So there's some convergence between what the consultants do and what the resellers do. So again, if you're a small business, you may not be able to afford an Accenture, for example, but your local value-added reseller, they will have engineers and technical sales folks on their stuff who can help you package and prepare a solution that fits your business needs. So that would be on the reseller side, as it alludes to the replacement cycle. And then on the consultant side, again, these companies, or at least the ones we've invested with, have pretty innovative culture. They hire young people and they try to be pretty decentralized and innovate, stay at the forefront of technology. And generative AI is just another technology. So again, it's very early to tell, and we could definitely be wrong on this, and it could have much farther implications than we think. But this is very much akin to other technological shifts that consultants have had to work through. So as an example, in the late 90s, as packaged software started to come out, so Oracle, SAP systems, people were concerned that there wouldn't be any services left for these companies to work on because, software is eating the world. Well, guess what? Someone had to implement these technologies and help their clients work through that, and that was the consultants. Then over the past few years, it's been the cloud industry, so customers transitioning to the cloud. And again, the concern was that once you transition to the cloud, well, then there'll be no more work for consultants to do. And guess what? Once again, they helped their clients go to cloud and then prepared them for the next phase, which is now generative AI. So again, with generative AI, based on all the channel checks that we've done, there is a very heavy lift involved to get the data clean and ready to use. So it's not as simple as just asking a generative AI program or module to build you a client portal, for example. it's not that straightforward. You have to get the data ready, you have to build the infrastructure, and then you have to design an actual solution that's industry specific. And once again, clients are going to IT consultants to do this. And that can be both small clients that don't have in-house expertise, but also big ones. So even companies like Priceline, let's say a huge technology company in the US, they use consultants to help them on this journey. So again, I think clients will always need expertise and help, and the firms that have the right culture, the right incentives, and that keep evolving with their customer to provide value, they will continue to do well. As opposed to the ones that maybe stagnate and provide lower end services, those ones probably have more of a difficult time as a lot of the work gets replaced by some of these solutions.
Yeah, it's always fascinating to me that those business models on the surface, they seem very transactional, whereas when you get to understand them a little bit better, they obviously have a high degree of recurring revenue because of the services that they're layering on top of all of the other distribution that they're doing.
Yeah, one of the sayings we sort of have observed is that there's two things that always seem to go up, and that's taxes and IT costs. So I think it would be hard to find many businesses these days where the cost of IT is going down. So you're right that it is transactional in terms of the actual goods and services that change hands, but it is very relationship oriented in terms of the nature of the business over the long run. So customers keep coming back to trusted advisors, and that's more of a relationship repeat sale, which is something that we like. That said, there is still cyclicality in the IT industry, so that's not that doesn't go away, but the long-term trends continue to be fairly positive.
All the more important to keep an eye on that culture of innovation and making sure that those companies and management teams have good alignment in terms of incentives to think long-term through those different cycles. Before we wrap up, Karan, I always like to hear more about some of the individual stocks in the portfolio. There were a couple of, I think, are good illustrations of our philosophy and our process. CBIZ, which is a professional services firm. We've held that, I think, since 2019. And Convatec, which is a more recent holding. We've now been invested, I think, for a little over 2 years. Talk us through those two names and where they fit in the portfolio.
So I think before we actually get into those two names, one piece I do want to touch on is the reason why they sort of are a good fit or example of our philosophy. So if you look just top down at the strategy, one of the things that we're really looking for is these resilient businesses. So ones that do well through thick and thin. And I touched a little bit on this when we spoke about the geographies. So that's one piece. And then the other piece as well is we want them to be well run with strong managers that are reinvesting capital intelligently. And then we want them trading at reasonable valuations. And when on the bottom up level, we take companies like CBIZ or Convatec and others, and we aggregate them, what we see at the portfolio level is actually that the strategy, yes, is pretty resilient relative to the average or the benchmark. It tends to have much more profitability or returns on equity using less debt. And then also it trades at a discount now relative to the benchmark from a multiple standpoint. So again, all of these things give us some comfort in sort of the positioning of the portfolio. And it's a function of picking individual companies and brick by brick building the portfolio. And if at the underlying level we have solid characteristics that we're looking for, then we also double check at the portfolio level that we're also positioned well. So that's just a quick piece on sort of how we think about portfolio construction maybe. And then if we go into these specific companies, as you alluded to, maybe the first one, CBIZ. So yes, long-time holding, pretty straightforward business model. They're an accounting and financial services provider. So they're more of a regional accounting firm that helps smaller to mid-sized clients rather than, let's say, the big four. So the KPMGs and Deloittes of the world. So they're more of a regional accounting provider. And despite this, as you can imagine, it is a very recurring business model. Corporates are very hesitant to switch their accountant. There's a lot of risk and work involved with switching your accountant. And as a result, they benefit from strong customer relationships, repeat business, and also the ability to pass through inflationary pressures. So that's something that we've seen really strong over the past few years is the untapped pricing power that they had in the ability to pass through wage inflation. Because again, some of these resources like accountants, like financial service advisors are pretty scarce. So they've been able to pass that through quite nicely. The industry itself continues to consolidate. As the demands for better technology go up and people goes up, it becomes more and more difficult for the very small accounting firms to stay afloat. And CBIZ has been playing their part in this by growing both organically and then doing small tuck-in acquisitions of firms that fit well with the culture and that can benefit from the scale that CBIZ provides to invest in the back office and in the talent. We've been holding this company since 2019. Typical for us when a thesis plays out that we continue to own it for pretty long, often 5 or 10 years. And the company still has a reasonable valuation and is managed by a long-time executive that's been there for several years and continues to just play the plan when it comes to the strategy. So that's CBIZ. Okay, and then the second holding, Convatec, a more recent one that we purchased around 2 years ago. And we found this thanks to a hint or tip from our colleagues in the Global Equity Fund. And we also leaned a lot on the work that our colleagues in the EP Large Cap Fund have done as we research this company. So what they do is they're essentially a consumable medical device company. And think about adhesives or plastics that often are attached or inserted into the body. It could be ostomy bags or it could be bandages or wound care that are specialized for pretty severe wounds. And they usually operate in oligopolies. So these are markets that are consolidated with only a handful of companies that can develop these sorts of products. And they're often the number 1 to number 3 player in those markets. As you can imagine, patients are pretty loyal, as are nurses who recommend the product. No one wants to risk using a different wound care device or a different ostomy bag and having leaks, for example. So this is very sticky, recurring revenue businesses. And R&D is very important as well. So part of the story is the CEO who was brought in a few years ago was specifically brought in to improve their innovation engine. So increase R&D, invest more in the business, at the same time take out unnecessary back office costs. And he's been successfully executing on this for the past several years and trying to take the company from good to great. So we like what we see in this business in terms of the resilience of the demand and also the upside potential if management's able to take the company to the next level. And we think that on that basis, the valuation is reasonable, given that we are seeing some evidence that the CEO is making good progress towards improving the company. And so that would be Convatec, another one of our holdings that really illustrates the type of business management and valuation we look for.
All right. Well, we've covered a lot, Karan. I think that's a great place to close things out. As always, great talking with you. And thanks for taking the time to jump on the podcast with me.
Thank you.